Hello and welcome back to The Long Short. So let me start today's episode by throwing out a few industry data points that might surprise you about the hedge fund industry.
Looking across the estimates provided by the most popular industry data providers, there are as many as 15,000 hedge fund firms globally, accounting for an estimated 4 to 4.5 trillion in assets under management.
That's right, and broken down by asset size, approximately 75% of the total number of hedge fund firms globally are running less than 500 million in assets under management, with many smaller or newer funds operating below this threshold. These managers feature many entrepreneurs and startup businesses, yet, in comparison to the multi billion dollar hedge fund business, which are a regular feature of the financial press and popular media, little is known about this part of the industry.
At AIMA, we've had the privilege of working closely with many of these smaller and emerging managers. They make up a significant portion of our membership by absolute numbers, and over the years, they've contributed immensely to our advocacy efforts, whether this is supporting our industry guidance work or through our next generation manager initiatives. And we've seen firsthand how these managers are shaping the future of the hedge fund space.
For nearly a decade, we've also been tracking the progress of this important sector through a series of research reports that examine everything from the costs of running a hedge fund to the milestones firms must hit on their way to becoming billion-dollar managers. Our latest report, Standing Strong, the 2024 Emerging Manager Survey, is now available, and today we're delighted to have a special guest to help us unpack the insights.
Lawrence Obertelli is head of EMEA Prime Services Sales at Marex Prime Services. Lawrence has been a key contributor to many of our reports on startup and emerging hedge funds over the years, making him the perfect guest to provide a deep dive into the trends and challenges facing these funds.
Lawrence, welcome to the Long Short.
Thank you so much, Tom and Drew. I'm very pleased to be here and excited to chat about all this stuff with you.
So, Lawrence, how would you describe the current landscape for small and emerging hedge funds, or as we like to describe them, the next generation of hedge funds?
Yeah, listen, it's a real mixed bag of sentiments out there, I must say. And when we think about landscape, in my mind, I like to think about what they're facing as opposed to what they're doing. And what they're facing, of course, and we all know it, is a very choppy and uncertain market out there. And I must say that is bringing a real diverse spread of returns. Clearly, some less positive and indeed negative, and some indeed that are faring well. So definitely a mixed bag in terms of the market conditions and returns. On the investor side, what managers are facing is also a bit of a mixed bag. Um, Look, asset raising, I'm sure the emerging manager community know it all too well. It is tough, it is challenging. It's taking longer to raise assets than it ever was before, and we'll talk about that, I guess, a little bit later. Um, However, on the more positive side, there's still this somewhat of a, let's call it a hangover from COVID, in that uh, before COVID, investors would have a very well diversified book of managers, but because of COVID, um, and because, of course, of the lack of on-site due diligence that they were allowed to do because of all of the travel restrictions, um, and meeting restrictions, we saw and the whole market saw that investors would allocate to managers that they either had already invested with, either currently or in the past, or managers that they'd done the due diligence on before. And that led to a very sort of concentrated set of portfolios around the world on the investor side. And over the last year, and perhaps a little longer, investors have been looking to diversify and get back to a more diversified set of managers in their portfolio. And that's still happening now. We're told that that is still happening now. So managers should benefit from that going forward in the near term. So that is definitely a positive thing for them to be facing. Um, on the other side, on something else, is the infrastructure. So certainly now, more than ever, I think managers can benefit from their supply side, their supply chain of providers. Again, now more than ever, outsourcing and various different vendors has become far more prevalent in the chain of manager infrastructure, and there's just a very healthy supply of vendors and outsource providers, not only in terms of the quality, but in terms of the number and competition. So, for when managers are thinking about their operational infrastructure, I think they're facing a very pleasing landscape. At least we can say that.
Lawrence, it's so interesting you say that about the smaller fund managers' ability to raise assets and how that's shifted since COVID. Our most recent hedge fund confidence index also identified that trend where going back sort of over the prior 4 quarters and maybe a bit beyond, it was extremely difficult. But our numbers did indicate that there was some easing of the challenges. Not to say that it's easy, and as you point out, there are new problems in terms of the lengths, but it was interesting that our data does chime with that, what you're seeing on the ground as well. Before we go any further, it would be good just to maybe define our terms a little bit further. Tom gave some data in our introduction, but when we're talking about the typical size of an emerging hedge fund, both in terms of assets under management and the number of personnel, could you just give us your definition of the smaller or emerging manager?
Yeah, sure. I mean, just to repeat the definition from the intro, yeah, look, emerging managers are loosely defined as 500 million and below. We did have this survey, and the average of the survey um, is somewhat lower than 500 million. We had lots of different respondents throughout that sort of definition from 0 up to 500 million, but the average was more like 107 million. Now, look, there's been a bit of a look. We've been doing this survey for a long time, right? This is number four, and that those four surveys span about 8 years, and we've seen a bit of a downward trend all the way through those surveys. So, in the very first one, in 2017, the average emerging manager respondent was about 150 million, and that has been coming down gradually. The survey after that was 123, and then the one after that was 112. So I think if you look at the average now of 107 versus last time round 112 million, one would like to think that there's a bit of support now at these figures. We can say that yes, whilst emerging managers are yes 500 million and below, the averages we're seeing are just around just over 100 million. In terms of size, they're around about 7 people.
Mm.
That was in this year's survey, and it corroborates last year's survey, also around 7 million. Now, pre-COVID, those last two surveys that I mentioned were both post-COVID. The two surveys that we did prior were pre-COVID, and the personnel was 8 on average in both of those two surveys. So there has been a small reduction, one headcount, but we again feel that there's support now at 7 people. So there's pretty strong support for 100 million being the average, certainly in the survey of people that we asked, with 7 people. I think it's quite interesting to contrast that a little bit, perhaps not with the billion-dollar club, which can be many, many people. Um, but look, we did also survey some managers in the 500 to a billion category, and their headcount was quite a lot larger. Their headcount was around 13 or 14 people. So there is a pretty big difference between emerging and sort of before the billion-dollar club. And of course, after the billion-dollar club, all bets are off. You can have many, many dozens, if not hundreds.
Yeah, and that's a global average, Lawrence, right? It's not indicative of any region having more than any other, or any strategy, indeed, having more personnel than any other.
Yeah, that's correct. I mean, the it is a global average. It didn't vary that much from region to region, so I think it's fair to say that on average globally, there is pretty good support around these AUM figures and headcounts. Of course, it does vary, but I think it's fair to say that that is a pretty indicative average.
Yeah, so I think it's fair to say you're describing it as somewhat of a boutique part of the industry, certainly when it comes to numbers of persons in these firms on average. But Lawrence, talk to us a little bit about the hedge fund strategies that emerging managers are primarily focused on today. Have you seen any notable shifts during the time that you've carried out this research?
So the interesting thing actually is that there wasn't an enormous shift, and that is just lots and lots of support to corroborate the point that equity long short has always been and still is by far the dominant strategy. Now, look, around 40% of managers are in that bucket today, and that's always been pretty much the case. It was a little bit more before. It's come down a little bit, but not by very much. And after equity long short, there's quite a big gap. So much lower down with shares of about 14 and anywhere from 10 to 14%, get a big grouping of the rest of strategies. And the interesting thing as well to look over the years is there haven't been a huge shift in percentage shares of strategies. It's largely been equity long short, with a big grouping of the rest, except for one, and that is credit. Now, obviously, with the rates of interest being hiked all around the world, it does stand to reason that credit has increased. Now, it's increased, but it's still not a large share. So at the moment, we're seeing about 10% of managers that are credit. The point is that previously it was, and of course, in much lower interest rates environments, credit were far lower, with sort of 5% and below of managers with credit focused. So yeah, look, they've doubled, but from a low base. So credit is definitely sort of the one strategy that's on the move. I think an interesting point to talk about is niche strategies. I think what we found many years ago is that managers were very keen to stand out from the crowd. They hated being bucketed into event driven or equity long short. They didn't like having these standardized terms, and they didn't like being pigeonholed within these standardized asset class names,
Mm.
strategy names. So they would often label themselves as other, and within that they would try and put some very interesting sub strategy name and appear, perhaps try to appear a little bit more interesting than they were, giving themselves all sorts of interesting names, but in reality they were probably just equity long short. Um, Now, in the past, that was about a third of managers doing that, right? So a very large chunk of managers trying to stand out from the crowd. This time round, so presently in 2024, but also in the last survey 2 years ago, that was a much lower fraction. So this whole point about finding support these days, we feel that managers are, let's say, a little bit more comfortable in their own skin. Around 10 or 11% of managers are only 10% of managers are in that other bucket, and yeah, everyone seems a little bit more comfortable with a proper traditional label.
So standing out from the crowd by being part of the crowd.
Yeah,
That
you have to be in the crowd and stand out for
yeah.
other reasons, perhaps performance for one, rather than your sub strategy interesting made up name.
Good for marketing a fund, less good if you're the one trying to create clean data sets of these managers and bucket them for statistical analysis reasons. But
Well, it's funny you say that, and I think that was one of the main reasons to get back to a core traditional label is actually investors did like to pigeonhole managers, and whilst managers were trying to fight against that, it perhaps didn't work in their favor. And as I say, now only 10% find themselves in the other category, and the vast majority are happy to have a label, a traditional label.
well, I for one welcome that. Let's talk about some of the operational costs that the research highlighted. Could you just help our listeners understand what some of the key operational issues are for the launch and managing of an emerging hedge fund? Particularly, we have focused throughout the research series around this idea of the break-even figure being this all-important number or ratio, I should say, that emerging managers are trying to reach. And there's all sorts of ways that they can do that, including salary sacrifice and other ways. But maybe you could just start by defining what we mean by break-even here, and then just explaining what the key costs are for managers in those formative years.
Yeah, listen, I mean, break even would be the number of AUM it takes to make a profit, very simply. Um, in the past, at the start of all of these series, these reports about 8 years ago, as I say, that figure was about 85 million. Um, so, it did seem somewhat out of reach for some startup managers. And what we found sort of post COVID is a lot of managers trying to very obviously and for very understandable reasons, reduce their costs. And break-even AUMs came right down. They came down to the sort of $65 million ish region. And what we found in this year's survey is, again, a level of support. So it was almost exactly the same. So 65 million this time round, 64 million last time round. So it's really finding this level of support there. Look, strategy wise, it does vary by strategy, right? Um, Global macro was the most notable change. Um, it used to be the second highest, with break even at 74 million, and now it's the lowest, with 47 million. We look. This wasn't just a survey, right? We spoke to lots of managers and got feedback and had roundtables, as you say, and the feedback that we got was that it was somewhat easier. I hate to use that word easier, but somewhat more able within the global macro strategy world, um, to cut your costs. And it was perhaps easier for a manager to have less analysts, pay for less research, use instruments, for example, like ETFs and futures that were more cost effective to really bring down their costs and to do their own analysis of those fairly simple instruments. So, that's quite interesting. Look, the other strategies, yes, they did vary a bit, but they were largely constant over the four different surveys that we've done. So it's really global macro that's changed the most. Regionally, it's not the same. So what we found is actually that managers in Asia do have a higher break even, over 100 million, just over about 101 million is what we found. Next was the UK, just under 100 million. North America, quite a bit under that, around 80 million, and Europe, being the most cost effective with a break even of about 75 million. Um, Look, operating expenses, if we sort of stray away a little bit from break even, operating expenses have come down. And this is, how do we define this? This is basically all of your costs divided by your AUM. So we found that operating expenses are, um, they're almost as low as a percent now, whereas previously
Wow.
they were over 1.1%. So, managers are very clearly bringing down their costs and enjoying better break evens, or at least more accessible break evens. And look,
Lawrence, just on the operating expenses, would you mind just explaining that a little bit more than for the listener what you mean by 1%? Is that 1% of the total assets then? Yes.
yeah, so if you think of if you had 100 million, it's
Yeah.
going to cost you roughly a million to cover
Mm,
all of your costs.
right.
If your
Very
operating
helpful.
expense is 1%.
Yeah. So is there a particular sweet spot then that the research has identified regarding the size of the fund or the type of investment strategy or even the location that could point to some kind of unique formula that emerging funds could follow?
Well, look, so we're talking about like a formula, like a
Yeah,
successful
is there a
formula for fund.
formula that funds could follow and say, okay, we're looking for, if we're trying to break even, then maybe it's that we need to be based in a certain part of the world or we need to be following a particular type of strategy? Or is there anything that the research has pointed to at all?
Yeah, well, look, let's start with strategy.
Yeah,
We talked about what strategy the managers are providing. But actually, we've done these surveys and it's always been asking managers questions as well as their investors. So we do have some pretty interesting information about what investors are interested in.
right,
And what we found is that there's a very good alignment between investor strategy preferences and managers. So by far and away, equity long short is the most sought after strategy for investors, and of course that's why we find so many in the equity long short on the manager side. So if we're thinking about a successful formula, one has to very seriously think about equity long short as a viable strategy.
right.
The other thing that we saw in terms of, let's say a mold or a successful formula, is the location. Um, a Cayman fund is by far the most popular, with over half the share of all of the jurisdictions you can think of in the world. Cayman was well over half, of that share, and it's always been the case, and it's never really deviated from this sort of over 50% figure. It's really been around that. So one has to think very carefully if you're trying to sort
Mm.
of have a successful formula. If you're going to go away from Cayman, one has to think very carefully about that and have some very good reasons. Um, Another thing to think about very carefully would be liquidity. So this is almost a little bit of a word of caution. 50% of investors that we surveyed would not tolerate a lockup of more than 2 years, and so
Interesting.
it's a very dangerous thing. I think perhaps that's a strong word, but it's somewhat dangerous to think about funds with more than a 2 year lock. And the feedback that we got is if you were going to have more than a 2 year lock, that it really has to match with the liquidity of the underlying assets, to not just ask for a long lock because you would like to have one.
Mm.
Um, Something else that we found that was quite interesting in the fund, in the survey, was to have just one fund these days. It's a
Yeah.
little bit similar to the point I mentioned about earlier in terms of standing out from the crowd. Before, lots of people were trying to stand out from the crowd with their niche strategies and by having many of them. And they would offer various different products, and it was quite common to have two, three, even more funds and strategies on offer. Whereas now, very much it's the case that managers are focusing on one fund. That was the case last time round post COVID as well. So again, there is a support around this feeling of basically focusing on a core strategy. Another small word of warning here, around terms, and that is a high watermark. Make sure you think very carefully about having a high watermark, because 80% percent of managers have one now. If you're not going to have one, you're going to stand out for the wrong reasons. Something worth considering, it's less of a caution, but it's just a point to consider, is a hurdle rate, because now about a third of managers have a hurdle rate.
Mm.
So if it's relevant, if it's possible to have a hurdle rate for your strategy, it could be sensible to have one. And then one last point, I think, just briefly, is to think about ESG. Look, there's been so much thought around ESG over the years, and I think there's been more and more pushback over in more recent years around ESG, certainly on the manager side. And we thought it would be fun to find out how much investors cared about ESG. And sort of somewhat tongue in cheek, we put this question in there, thinking that perhaps something like the vast majority, if not all, of investors would not at all anymore care about ESG, but that was not the case.
Mm.
Whilst the number was high, around 75% of investors um, didn't factor ESG considerations, what we found is that those 75% ish of investors were the less institutional, smaller investors, i.e., the family offices and multifamily offices, but the larger, more institutional investors, larger endowments and foundations, they very much did care about ESG. So whilst managers now, it may not be part of their successful formula to have ESG built in, it certainly may be in their future if they're going to push on and raise more assets and attract more institutional money.
Yeah, and just to clarify that point, Lawrence, the points that you make relate to the emerging manager part of the industry as opposed to the wider hedge fund industry when it comes to the appetite for ESG and the need to have ESG at the fund or the firm level and what investors are looking for.
Yeah, absolutely. So the investors that we are, one of the prerequisites really, when we were asking investors these questions, was that they invested in emerging managers.
Yeah.
So all of their answers pertain to what their feelings were towards investment,
Mhm.
towards emerging managers. So yes, when we talk about becoming more institutional, we did talk about it earlier. Once you surpass the, let's say, 100 million mark, we can start thinking about more institutional money. You're still going to be within the emerging manager space, right, between 100 and 500 million. And at that point, you do very seriously have to think about ESG.
I want to move on to talk about fees as sort of the other side of that coin. But just before I do, I really want to um, crystallize this idea because I think it's so important how you sort of describe those. Of course, they're just guidance. There's no hard rules in this game. But when you're talking about standing out in terms of the right ways, but not the wrong ways, and you've sort of sketched out what some do's and don'ts might be. But just to tie it back into this point around the due diligence process, if you imagine that an investor is being bombarded with emerging managers seeking to stand out, and you are one of them, but you are, to use sort of the antithesis of your description, you are a long short equity manager with the fund not in Cayman. You don't have a high watermark. You have a very long lockup considering the liquid markets that you are trading in. You are going to have to answer some very difficult questions about why you are doing these things and sort of zigging when others are zagging. And that will contribute to a very long due diligence process that may rule you out. Am I describing that correctly?
Yeah, I mean, look, I think you sort of painted a picture there of almost what not to do, and I think our survey has been very informative to the market, particularly for emerging managers. That there were always lots of hedge fund surveys out there. The thing I think that's unique about the way we've done this is we have focused on emerging managers and brought some very consistent and long-term data around this. And what we've found is very clearly fees have been supported at a level, and we've seen this point of support come up time and time again, supported at a level of around 1.4% for management fees and about 16.5% for performance. And that support is not just this survey and last survey. Actually, all four surveys have been very strongly gathered around these averages. So, in terms of almost like signaling, everyone knows this. Our surveys have got round. Everyone knows that one has to basically be in there, and it's almost a, a cautionary tale for anyone to sort of step above that, especially as, again, going back to the fact that we surveyed lots of investors. One of the things that we asked investors was, what would their barriers to investing be? Um, One of the most obvious and one of the most clear signals they gave was about having excessive fees. So 60% of investors would immediately block an investment if they thought the fees were were excessive. So I guess the question is what can you do? So very clearly stay around those averages. You don't necessarily have to go under them, um, but something that one could maybe think about is a managed account. Um, a managed account is becoming more and more popular. And I think for emerging managers in particular, um, they may be the part of the market that is more amenable to them. I think billion-dollar managers can afford to be a little bit picky and perhaps do offer managed accounts for the very, very largest of tickets and clients, whereas emerging managers are going to be more amenable to them. And then, of course, fees can be negotiated bilaterally, and of course are less publicized and signaled to the rest of the market. But if you're going to have a commingled fund, it's very well signaled to everyone that 1.4% management and 16.5% is for performance is where you need to be pretty much.
Lawrence, do you have a sense as to where, on average, in the the life cycle of these emerging hedge funds, where they may start to get on the radar of investors? And we're talking about a variety of investors, of course. We're talking about from the family offices right through to maybe some of the institutional investors.
Yeah, so look, again, we did speak to a lot of investors and ask questions around this. Um, we all know out there, and it's sort of colloquially banded around, that 100 million is the mark that institutional serious capital, it starts becoming available to a manager. But actually, this survey does back that up. So on average, and I do want to stress this word average, on average, emerging investors would consider 100 million as their smallest investment. I want to be clear about that. 100 million of AUM would be the smallest manager that they would invest in. Um, there's some good news on this figure because previously this AUM figure was larger. It used to be around 150 million. So there's been a sort of 30% decrease in the size of manager that the average investor would look to invest in. Now, again, I'm going to stress the word average, because how does this figure come down? Well, it's obviously hiding the fact that there are much smaller managers attracting capital. And what we found this year is that there are more and more investors allocating, or at least happy to allocate or consider allocating, to managers in the 50 to 100 million bucket, and that's gone up from about 15% of investors last time round to just over 30% this time round, happy to consider these managers in the 50 to 100 million sort of AUM region. So whilst we can talk about this 100 million being the average, and it's the case and it's corroborated, there is definitely some positive scope for attracting capital when you're less than that, between 50 and 100 million.
Maybe if I could just throw a broader question at you, maybe going beyond the findings of this latest report, because I really liked what you were saying before, and just really having these sort of concrete ideas that people can take away from this conversation. Is there any other guidance that you, sort of from your seat, would give to emerging managers when they're trying to attract investor attention? And I guess that could be something very tangible to maybe some of the more soft skills that might help you along the way.
Well, I think the good news for managers is that there's some very, very strong and clear signals about this. Investors were very clear. I mean, 65% of investors told us that their most recent ticket was sourced from their personal network. So it stands to reason, and very obviously, that managers need to be good networkers. There is no getting away from that, whether you like it or not. The second way that a manager might sort of attract capital is via their capital introduction contacts. So 22% of investors found their most recent ticket from a capital introduction contact. So you could almost bracket both of those in the sort of wider networking point, and that is very clearly managers need to speak to a lot of people, whether it's their own friends or whether it's their prime brokers capital introduction teams, and of course make sure you have a prime broker with a good capital introduction team. You're going to have to spend a lot of time talking to people. There are some other things that managers can consider. I often speak to managers a little bit concerned, if not insecure, about their track record, thinking that they're after institutional money, they need 3-year tracks, they need 100 million. It's not always the case. Look, it is true that some institutional investors do want a 3-year track, and we did find even that sort of 22% of our investors did say they want a 3-year track. But the encouraging sign actually is that investors in the emerging manager space, about 50% of them are happy to allocate to managers with a year or less. So I guess the word of advice to managers is to not necessarily be insecure about not having a 3-year track, but to find the right type of investor for the journey and the part of the journey that they're currently at. So if you are less than 100 million with a 9-month track, then make sure you're targeting, let's say, for example, single family offices and not the largest pension funds in the world. And that goes back to Cap Intro and working with a Cap Intro team that understands that. A couple of other quick points is very much a manager, and this is a little bit more in their own hands, is to focus on their operational framework. Because again, going back to what stops an investor allocating, 83% of investors said that a poor operational framework would block their investment. And it's sort of a similar topic here is the business plan. Make sure you have a strong business plan, because 66% of investors would not allocate to a manager with a poor business plan. So there's some things there that managers can do that are very much in their own hands as well to appeal to investors.
That's very, very interesting, Lawrence. Aside from what you've mentioned, when we think about those firms who are at the very beginning of their life cycle and they've secured their first investment or upon launching? Are there any other unique hurdles then that they may face?
So again very well publicized out there that it is tough once you've launched. What we've found, and this has been consistent through our series of reports, is that there's a challenge of scaling up. So you launch and you stay at sub 100 million for some time. And what we found is that actually managers that were older than 5 years and less than 100 million of AUM was fairly common. Almost a third of the managers that answered our survey this time round were in that category. So, we've said it many times, raising assets is going to be a struggle, and we've got the evidence to show that. But again, there are some things that you can sort of take under your own control, and that is avoid at all costs style drift. It can be tempting to get into other interesting areas of investing that may not necessarily be strictly core to your own strategy and your own prospectus, and that's going to be problematic. Around 70% of investors would not allocate to a manager that they perceive to have had style drift. Another thing that a manager could do is to upgrade their infrastructure. It's going to be challenging, of course, with lower AUMs. But what we found, if we contrast with some managers that are slightly larger, again, we did speak to 500 million and 500 million to 1 billion managers. Their break-even AUMs were more than double that of an emerging manager. So around about 130 million of AUM was their break-even. So very clearly, the challenge that an emerging manager will have is to scale up their infrastructure, add in costs very intentionally, add in bells and whistles. But it's very much within their control, and they have to manage that as their AUM goes up to make sure their costs and again their operating expense ratio doesn't sort of spiral out of control. And again, this very much comes back to the point about an operational framework not being up to scratch being the number one reason to not invest from an investor's point of view, because as you get more assets, you will be expected to have a far better operational framework.
And you mentioned performance there. So just to sort of dwell on that for a second, how important is it to remain consistent in your performance, both in terms of for the hedge fund survival naturally, but also when it comes to their attractiveness to investors? And I guess what I mean by that is how important is it to sort of deliver around the range that you expect to deliver based on your strategy, rather than maybe shooting the lights out one year and then having a disappointing year, and although that might average out the same, it maybe is disconcerting. So to investors, that is. So could you just speak around the need for consistency?
Yeah. So look, again, we did speak to investors a lot in these survey series, and the feedback that we get is that the emerging manager space is a higher risk proposition to them versus the billion-dollar club, and with higher risk should come higher reward. And that, of course, comes with it a lower tolerance to volatility, or at least unexpected volatility, and indeed unexpected drawdowns. So one could say that the emerging manager, and I think it's a fairly obvious thing to say, is that emerging managers are far more vulnerable to redemptions anytime that a manager has a perception that the risk reward is out of control. Um, this can be coupled with, again, the operational side of things. Clearly, I've mentioned it a few times here, it's the number one reason that an investor would not invest, but it's also probably the number one reason why an investor might redeem. So you must have a consistent sort of feeling of operational soundness with your investors. They have to have confidence in your operational infrastructure, and this goes back to the point just earlier about upgrading it as AUM increases to make your investors feel that they have confidence in your operational infrastructure as you grow, as well as when you just launched.
Lawrence, we talked at the start of the episode about the absolute majority of funds that are in this bracket 500 million and below make up the industry by number. They do not make the industry up at all by assets. I think it's quite the opposite, or even more extreme, in that 90 to 95% of the industry's total assets are managed by a much smaller percentage of funds, as a measure of the total number of funds in the industry. The report goes into, and indeed the series of research goes into, how these small and emerging hedge funds are able to compete with the larger, more established players. What strategies are you seeing that are working for them?
Look, the most obvious thing to say is, of course, around fees and your terms. I don't want to dwell on this point too much. We've already talked about, it's very well signaled, and of course, the billion-dollar club have fees far more, far in excess of that of the emerging manager space. So be very careful around the fees and the terms. Something to talk about a little bit more, perhaps, is the closer relationship and higher level of service that a manager can offer their investors, almost to bring a feeling of as being the sort of personal money manager of a particular client or group of clients, which may be a very different experience for a smaller investor at a billion-dollar manager. So that can certainly appeal and attract assets to a startup or emerging manager. One of the other things I think that really benefits emerging and startup managers is their agility. Um, as new and interesting trends, and again, being very careful not to drift in style, but as new and interesting opportunities arise, smaller managers are going to be far more able to adapt and reorganize themselves quickly than a billion-dollar manager. Um, and that's also true of SMAs. We did talk about SMAs becoming more popular, but why? Often, what we're seeing and what I hear from my Cap Intro colleagues is that an investor will ask for an SMA not necessarily just because of fees. Um, Fees will be part of the discussion, but perhaps they're asking for something slightly different. Perhaps they're saying they like the long biased main master fund, but perhaps they'd like it a little bit more closer to a tighter net. We've often heard of investors asking for the short only part of a book or the long only part of a book, and adapting and accepting those challenges is something that is definitely within the hands of emerging managers, and I think benefits them above their larger competitors. Basically, just the general point is to be accepting and more agile and more able to approach these various different opportunities.
Have you seen any trends? Because I think we've talked about this, but maybe to dwell on it for a moment, we've talked around it, I mean, but dwell on this for a moment more. Have you seen any trends in the time it takes for smaller funds to onboard new investors? And what would you say are the key challenges in that process?
Yeah, so for years, and again, this survey series has been going around about 8 years. For years, we found that in the single family office space and somewhat less institutional investor space, that investment was taking around about 6 months, and that is from the very first conversation to investment actually getting into the fund, and that was quite well publicized and signaled for a long time. What we've found recently is that that has gone up. So obviously this is less positive news. It's gone up from about 6 months to about 8 months. There's some very good reasons for that. We did have various feedback sessions, as I mentioned, and the feedback we got was that due diligence is a far more thorough and institutionalized process these days. Of course, due diligence was always going on, but going back to the point I mentioned earlier about there is a vastly more healthy, competitive landscape out there for vendors. That's definitely true of operational due diligence firms, and investors are also outsourcing. They're outsourcing their due diligence to some of these firms, or they're actually doing more of it themselves. But the general point is that operational due diligence is far more thorough and is taking longer and can attribute for a large part of this increase. So look, we've often heard that. Look, this again averages, right? We've heard that this 8%, this 8 month, this 8 month figure, it can be far longer than that. We've heard of due diligence taking over a year. Um, Look, it just is what it is. It's something that investors and managers are both going to have to deal with. And the reality is that as everyone outsources more, there is just far more pieces of the puzzle, layers to the onion to speak to get data from, and to due diligence on. So all of this does mean that the trend for gaining assets, is taking longer, I'm afraid.
Lawrence, just coming into the last few minutes of the episode, this has been really insightful. But a couple of questions for you. From your perch as a prime broker that serves a lot of this industry, are there any sectors or any regions or strategies that you see as being amongst the most exciting opportunities for small and emerging hedge funds?
Well, if we talked about the average of being, 100 million in this sort of space, let's sort of focus on that. And the single family office are the ones most likely to allocate to a sub $100 million manager. 82% of them are happy to allocate to that part of the market, the sub $100 million space. So, you know, it might be interesting for larger endowments and foundations to come into play, but that's not going to be until after 100 million. So very clearly focus on the single family office for the smallest of emerging and startup managers. It's a very clear sign.
And any regions that you see as being particularly exciting or attractive? A lot of talk about the Middle East at the moment.
Yeah, of course. I mean, traditionally, I think it's pretty obvious. It's historically been the United States when it comes to investors. But look, in the press for 2 or 3 years now, the UAE, in particular Dubai, and of course Abu Dhabi as well. There's been a lot of press of all of the very largest multi-managers all moving out there. And of course, what history tells us is where there's any large multi-manager community, there will be
Right.
spin-outs and there will be emerging managers and new launch managers. So that's very exciting and something to keep an eye out on. And my colleagues in Cap Intro do tell me, in fact, that it's also becoming more and more interesting on the investor side too. And the region is very well now renowned for its sovereign wealth and very, very enormous funds. But more and more, they're seeing smaller institutions, smaller family offices and multifamily offices that are very much open to emerging managers. So I think that will be a region to keep a very close eye on. And then lastly, I hear, aside from the multi-managers going out there, I have heard that there are more and more emerging managers starting starting in the UAE. So I think all in all, the region is going to be very exciting. And we ourselves have made hires there, and we have put somebody in Cap Intro and indeed in Prime Brokerage Sales there very recently, because it is such an interesting space that we can't ignore. So yeah, very much so. I think the UAE will be a very decent focus going forward.
Well, we've covered a huge amount of data here for running almost a decade of market research. And I should say, for any listeners that want to review the numbers or get their hands on the full report, it is called Standing Strong, and it is available to download via AIMA.org in our research section. And if you're an AIMA member and want to get involved in our Next Generation Manager group or learn more about next year's event, we do an annual event dedicated to emerging managers, which Lawrence and his team have attended, and they are always there to provide really, really useful information for emerging managers, much like Lawrence has been able to do today. Please do get in touch with the membership team. But Lawrence, all that is left is thank you so much for joining us and sharing your wisdom with us today.
Thank you so much for having me again, and it's been a real pleasure.